The median home price in America just crossed $410,000. Let that satisfying number sit in your brain for a moment. $410,000. For a starter home, not a mansion, not a penthouse, a basic, entry-level, three-bedroom house with a two-car garage in a decent neighborhood. And here's the part that should genuinely terrify you. By the time you actually finish paying for that house, you will have handed over more than $1.2 million for a $400,000 house. But that's not even the worst part. The worst part is that after 30 years of payments, after draining your bank account every single month for 3 decades, you might actually end up with less money than if you had never bought the house at all. My name is Nick, and I create easy-to-understand animated videos about personal finance. If that's something that interests you, consider subscribing. Today, I'm going to walk you through a piece of math that the real estate industry, mortgage lenders, and your well-meaning parents desperately do not want you to see. It's called the starter home trap. And once you understand it, you will never look at a for sale sign the same way again. The starter home trap is not about whether homes are good or bad. It's about a specific mathematical prison that gets triggered when you buy a home you can barely afford, at the wrong time, for the wrong reasons, using money that could have been building real wealth somewhere else. Banks understand this math perfectly. Real estate agents understand this math perfectly, but neither of them has any financial incentive to explain it to you. In fact, they profit directly from you not understanding it. Here's what I promise you by the end of this video. You will know the exact dollar amount your starter home is actually costing you every single month, and it is not the number on your mortgage statement. You will see the specific calculation that shows how much wealth you are silently losing to this trap every year, and you will have a clear, step-by-step plan to make sure you never fall into it. So let me take you back in time for a minute, because the starter home trap didn't always exist. It was manufactured. In 1970, the median home price in America was about $23,000. The median household income was around $9,800. That means a house cost roughly 2.5 times what a family earned in a year. 2.5. That's it. A regular family on a single income could save up, put money down, and buy a house without their entire financial future depending on it. If something went wrong, if someone lost a job, if there was a medical emergency, the family had breathing room because their housing payment wasn't swallowing their entire paycheck. Fast forward to today. The median home price is $410,000. The median household income is roughly $84,000. That means a house now costs almost 5 times what a family earns. And in many cities, that ratio is closer to 7, 8, even 10 times annual income. The Home Affordability Index in America just hit a 50-year low. Not a 10-year low, not a 20-year low, a 50-year low, the worst housing affordability since your grandparents were buying their first homes. Elizabeth Warren, before she was a senator, was a Harvard bankruptcy professor. In 2003, she co-authored a book called The Two-Income Trap. She studied over 2,000 bankrupt families across America, and what she found was devastating. She found that the median middle-class family in the early 2000s was more than 4 times more likely to be house poor than a generation earlier. House poor meaning they were spending more than 35% of their total income just on the mortgage. And here's the really cruel part. Warren discovered that families weren't going bankrupt because they were buying boats and designer clothes. They were going bankrupt buying houses in decent school districts so their kids could get a good education. The cost of a middle-class life, driven primarily by housing, had outpaced income growth so dramatically that 2 incomes could barely cover what 1 income handled a generation ago. Since 1960, the median home price has increased by 195%. Wages during that same period? They went up 67%. Home prices grew almost 3 times faster than the money you earn. That gap is the foundation of the starter home trap. And now, in 2026, that gap has become a canyon. So let's do the math. Let's take this $400,000 starter home and break down what it actually costs you. Dollar by dollar, line by line. No hand-waving, no it depends. Just the raw numbers. You go to the bank. They tell you that with a 30-year fixed mortgage at 6.5% interest, your monthly payment will be around $2,300, $2,300 a month. That sounds manageable, right? You earn $84,000 a year. That's $7,000 a month before taxes. You can handle $2,300. That's what the bank wants you to think. That's the number they put on the paperwork. That's the number the mortgage calculator shows you online. But that is not what you will actually pay. Let's add in the numbers they quietly leave out of the conversation. Property taxes. The average property tax rate in America is just under 1% of your home's value. On a $400,000 house, that's $3,960 a year. Divide that by 12, and you're paying an extra $330 per month. Your monthly bill just went from $2,300 to $2,630. But we're not done yet. Homeowners insurance. You are required to have it. You cannot get a mortgage without it. The average homeowner's insurance premium on a $400,000 house is about $3,228 a year. That's another $269 per month. Your monthly bill just climbed to $2,899. I am not finished. Private mortgage insurance, or PMI. Because you're a first-time buyer and the average first-time buyer puts down about 9%, you don't have 20% equity, so the bank charges you PMI to protect themselves. Not to protect you, to protect themselves in case you can't pay. That costs you roughly $200 a month. Your bill is now at $3,099. And here's where it gets really interesting. Maintenance and repairs. Experts estimate you should budget 1% of your home's value every year for upkeep. That's $4,000 a year, or $333 a month. And that's the conservative estimate. Some experts recommend budgeting up to 4%, which would be $16,000 a year. First-time homeowners report spending between $1,000 and $5,000 on unexpected repairs in their very first year alone. A new roof? $10,000 to $15,000. A new HVAC system? $5,000 to $10,000. A burst pipe in winter? You're writing a check before you even have time to Google the plumber. So let's add that $333 per month in maintenance. Your true monthly cost is now $3,432. Let me say that again. The bank told you $2,300. The real number is $3,432. That's $1,132 more than what was on your mortgage application. Every single month. An extra $13,584 per year that nobody mentioned during the open house. Now, you might be thinking, well, Nick, $3,432 is still doable on my income. Okay, let's see. The median household income in America is about $84,000. After federal taxes, state taxes, Social Security, and Medicare, the average effective tax rate for a middle-class household is roughly 25%. That leaves you with about $63,000 in take-home pay. Divide that by 12, and you're bringing home $5,250 a month. Your housing costs $3,432. That's 65% of your take-home pay. Going to one single expense, you have $1,818 left. For everything, let me subtract what everything actually costs. $1,818 minus $700 for groceries for a family. You're at $1,118. Minus $500 for transportation, car payment, gas, insurance. You're at $618. Minus $375 for utilities, electricity, gas, water, internet. You're at $243. That's what's left. For savings, for emergencies, for entertainment, for clothing, for healthcare copays, for your kids' school supplies. For every other expense in your life that isn't housing, food, transportation, or electricity, $243 a month. And one flat tire, one emergency room visit, one car repair sends you straight into credit card debt. But it gets worse. Let's talk about what the bank actually takes from you over 30 years. You're borrowing $364,000 at 6.5% interest. Your monthly payment is $2,300 in principal and interest. Over 360 months, that's $828,000 in total mortgage payments. You borrowed $364,000. You paid back $828,000. The difference? $464,000. The bank collects $464,000 in pure interest, just for letting you borrow the money. That's more than the entire purchase price of the house. Let me frame this differently. You are paying for this house twice, once when you buy it, and once more in interest to the bank. Your $400,000 starter home is actually an $864,000 commitment. Before you add a single dollar of property tax, insurance, maintenance, or PMI. Now, some of you are already thinking, but Nick, the house appreciates in value. That's where the wealth comes from. Stay with me for 60 seconds, because this is the part that really breaks the illusion. Historically, homes in America appreciate at an average rate of about 4% per year. That sounds great. So after 30 years, your $400,000 house is worth about $1.3 million. You're a millionaire on paper. Congratulations. But let's add up what you actually spent to get to that $1.3 million in home value. Mortgage payments over 30 years, $828,000. Down payment, $36,000. Closing costs to buy the home, $14,000. Property taxes over 30 years, roughly $119,000. And that's using the flat rate, not accounting for increases as your home value goes up. Homeowners insurance over 30 years, $97,000. Maintenance over 30 years, $120,000. PMI for approximately 11 years until you hit 80% equity, $26,000. Total out-of-pocket over 30 years, $1,240,000. Your home is worth $1.3 million. You spent $1.24 million. That's a gain of about $57,000 over 30 years. That works out to $1,900 per year, or $158 per month of actual profit. But wait, you want to access that profit? You have to sell the house. And selling costs you another 8 to 10% of the sale price. Realtor commissions, transfer taxes, closing costs, staging, repairs to get the house market ready. At 8% of $1.3 million, that's $104,000. So your $1.3 million sale minus $104,000 in selling costs equals $1,196,000 in your pocket. You spent $1.24 million. You got back $1.196 million. You lost $44,000. Over 30 years of homeownership, after doing everything right, you ended up with less money than you put in. Not more, less. And I haven't even gotten to the worst part yet. Remember that $36,000 down payment, plus the $14,000 in closing costs? That's $50,000 you handed over on day one. What if instead of locking that $50,000 into a house, you had invested it in a simple S&P 500 index fund that historically returns about 10% per year? $50,000 invested at 10% for 30 years becomes $872,000. From doing absolutely nothing except letting compound interest work, instead, you locked that $50,000 into a house, and after 30 years, your net position is negative $44,000. The difference between those two outcomes is over $900,000. Now, you might be thinking, okay, but what about flipping it in 5 years? What if I build some equity and trade up? That's the starter home fantasy. Let me show you why the math doesn't work there either. You buy at $400,000. After 5 years at 4% appreciation, your house is worth roughly $487,000. Sounds great. But in the first 5 years of a 30-year mortgage, almost all of your payment goes to interest, not principal. After 5 years, you've only paid down about $23,000 of the $364,000 loan. Your remaining balance is still around $341,000. You want to sell? Here's the math. Sale price $487,000 minus remaining mortgage $341,000 equals $146,000 in equity. But you paid $36,000 as a down payment and $14,000 in closing costs to buy. You also paid $20,000 in property taxes over those 5 years. $16,000 in insurance, $12,000 in PMI, $20,000 in maintenance, and now closing costs to sell at 8% are another $39,000. That's $157,000 in costs on top of your mortgage payments. Your equity is $146,000. Your extra costs are $157,000. You didn't make money. You lost $11,000, and you also paid $115,000 in mortgage interest during those 5 years that you will never see again. The 5-year flip isn't a strategy. It's a trapdoor. Now let me be very clear about something. This isn't your fault. The system is designed this way. You grew up hearing, renting is throwing money away. Your parents said it. Your teachers implied it. Every financial guru on television repeated it like a commandment. And 30 years ago, they were right. When a house cost 2.5 times your annual income, buying made mathematical sense. When mortgage rates were 4%, the interest burden was manageable. When housing costs consumed 25% of a family's income instead of 65%, there was room to build wealth elsewhere at the same time. But the math has fundamentally changed. And the advice hasn't caught up. The people telling you to buy a starter home are using a 90s playbook in a 2026 economy. Here's what this actually means for your daily life. It means you're cutting coupons at the grocery store not because you want to, but because you have to. It means you're saying no to dinner with friends because there's $243 standing between you and your credit card limit. It means you're lying awake at 2 a.m. wondering what happens if the water heater breaks because the emergency fund you were supposed to build doesn't exist because every dollar went into the mortgage. An Insurify study in 2025 found that the hidden costs of homeownership, beyond just the mortgage payment, averaged over $21,000 annually. That's 27% of the median household income disappearing into costs that aren't even the house itself. And when they surveyed recent homebuyers, the regret numbers were staggering. Up to 82% of Americans who bought a house in 2023 and 2024 reported regretting their purchase. 82%. The number one reason: unexpected costs. They didn't know the math. Now you do. So here's what you actually do with this information. 5 steps. Step 1. This week, calculate your true housing cost, not just the mortgage payment. Add property tax, insurance, PMI, estimated maintenance, HOA fees, if applicable. Utilities. Get the real number. Write it down. If it's more than 28% of your gross monthly income, you are in the danger zone. That 28% number is called the front-end debt-to-income ratio, and it exists for a reason. If your all-in housing cost is $3,432 a month, you need to be earning at least $147,000 a year gross for that house to be financially safe. On a median income of $84,000, the maximum you should be spending on all-in housing is $1,960 a month. That means the maximum home price you can actually afford is closer to $225,000, not $400,000. Step 2. Before you buy anything, build a $20,000 emergency fund that has nothing to do with your down payment. This is your buffer. This is what keeps a broken furnace from becoming a broken life. Do not touch the down payment savings for this. It's a separate account. Step 3. Calculate how long you plan to stay. The break-even point on buying versus renting is currently somewhere between 5 and 10 years, depending on your city, and it's getting longer. If you're not absolutely certain you'll stay for at least 7 years, the math overwhelmingly favors renting, investing the difference, and staying mobile. Step 4. Run the opportunity cost calculation, take your potential down payment and closing costs, plug that number into a compound interest calculator at 10% annual return, look at what it becomes in 10, 20, 30 years. Then honestly ask yourself whether locking that money into a house makes more sense than letting it compound freely. Step 5. If you're currently renting, take the difference between what you pay in rent and what you would pay in true all-in homeownership costs. Invest that difference every single month into a low-cost index fund. A $1,400 per month difference invested at 10% annual returns for 20 years becomes over $1 million. Renting and investing the difference is not throwing money away. It is a mathematically proven wealth-building strategy that most people have been conditioned to dismiss. Now here's the thing. I am not telling you to never buy a home. A home can be a wonderful thing. Security, stability, a place where your kids grow up. But a home should be a financial decision first, and an emotional decision second. The starter home trap catches people who do it the other way around. They fall in love with the house. They stretch to make the numbers work. They convince themselves the math will sort itself out, and then they spend the next 30 years suffocating under a payment they can barely afford, wondering why they feel broke despite owning property. The median home price in 1990 was $79,000. Today, it's $410,000. That's a 419% increase. Wages in that same period went up about 130%. Home prices grew more than 3 times faster than what you earn, and yet the advice from everyone around you is still the same as it was in 1990. Buy a house as soon as you can. Stop throwing money away on rent. Real estate always goes up. Now you know the real math. The math they don't show you during the open house, the math that isn't on the mortgage application. The math that the real estate agent and the loan officer and the home inspector all profit from you, never seeing. You are not financially behind because you don't own a home. You are financially behind if you own a home you can't afford. There is an enormous difference. And now you understand exactly why. If this video changed the way you think about money, subscribe. I make videos like this every single week. breaking down the real numbers behind the financial decisions that shape your life. No fluff, no filler, just math. Hit that subscribe button so you don't miss the next one.